Practical accounting, the better way to learn.
This is module 2.1, cash versus accrual accounting. One sheet here. Cash accounting is what you're probably thinking like now, but we're going to convert you because accrual accounting has some definite benefits. Cash accounting recognizes revenue when it is collected and expenses when paid. This can be used for small business, but it can cause profit swings between time periods. These swings are managed more effectively by accrual accounting, which is used in this course. Now, when you think about this, if you have a job and you earn wages, that is revenue at that time, even though payday hasn't come. And the same thing, if you spend money and get a bill, you've consumed that resource, even though you haven't paid it. So we're going back to the revenue recognition principle. Revenue recognition principle, which we'll actually talk about in more detail, specifies that revenue is recorded when the performance obligation is satisfied. That is the exact terminology. I'm going to just tell you guys that means delivered. When you've delivered something, you can say, I made the sale.
Is that the same as being earned? Is that it?
Yeah, earned.
Okay.
Yeah, basically earned. Yeah, you can say, yeah. So that's like at the end of the day, you've earned your wages. Right. Right. The expense recognition, also known as the matching principle, specifies that expenses are recorded when incurred or used, okay, not when paid for. So in this example, we have a home repair business buys and pays for inventory and completes a job in 20X1, but does not collect the account. They give them a bill, but they don't collect until the following year, 20X2. So we have a very simple income statement here. Revenue minus cost of goods sold, which is an expense, is net income or loss. If we were doing cash accounting, they would recognize no revenue because they hadn't collected, but they would have the expense because they had paid it. So they would have a net loss in 20X1, and they wouldn't recognize the revenue until the following year. So they'd have $100 worth of revenue, no expense, and $100 worth of profit. However, this violates the matching principle, and it's a profit swing that just really doesn't make sense.
So what's the matching principle?
The matching principle, also known as the expense recognition principle, basically says that you try to match the revenue and expense to the same period, and accrual accounting does a great job of that. Let's take a look at how the accrual accounting would handle the same transaction. It would say we've delivered, we've earned it in 20X1, so we can recognize revenue and book it as an accounts receivable asset of a $100 bill. Accounts receivable is how you account for money that is owed you. Net income or loss would result as 40 all in year one, and there would be nothing on the income statement for year two. Expenses are recognized when used, even if not paid. So we're going to be doing accrual accounting in this course. You can get this Excel workbook and a whole lot more
Stuff for free at practicalaccounting.com.
See you there.